Hello, welcome to ACCA F3 Financial Accounting. Today we'll be learning about IAS 10, which is about events after reporting period. IAS 10 requires the provision of additional information on events which happen after the reporting date that could affect the position at the reporting date. So what this means is that when I have issued financial statements for the year end, I'm not going to publish this immediately. I'm going to do some review, and if there are any events which happen after the reporting period, then I am allowed to modify my financial statements. However, this period is between the year end and the signing period. The signing of the financial statements, this could be the signing of the auditors and the shareholders and the management and so on. So this is going to take place before the financial statements are actually published to the public, and only those events are allowed to be included as a justification to our year-end financial statements. Okay, so as you can see here, I've written that events after reporting period is also known as the events which occur between the reporting date, in this case the year end, and the date on which the financial statements are authorized for issue, which in this case is the signing part. So in other words, these events are what provide further evidence of conditions that existed at the reporting date and are indicative of conditions that arose after the year-end date. Alright, so in here I've listed down some examples of events which do require the financial statements to be adjusted. The first common example would be when a customer goes bankrupt. Now the thing is, at the year end, we have included our trade receivables at the whole amount. And so if a customer somehow becomes bankrupt after the financial year end, so the trade receivables figure that's listed in our financial statements is not entirely true. Because inside that amount, there is a customer who is already bankrupt and should be written off as a bad debt. So in that case, we're going to have to do some adjustment to our year-end financial statements and remove that customer. Now the next one is kind of like a downwards revaluation, in which case there is a permanent decrease in the value of our property in the year end. So if we have listed our property at some certain value at the year end, and subsequently there happens to be a downward revaluation, then that means we're going to have to also write down the amount. Otherwise, that would mean that we're overstating our assets, and that would make our financial statements not true and fair. Now here's another example: sale of inventory after year end for less than its carrying value at the year end. In other words, remember in IAS 2 we need to record our inventory lower at cost and net realizable value. So the point is that at the year end we're supposed to record our inventory at either lower amount. But if it so happens that after the year end we sell a portion of inventory and we're selling it at a price that is lower than its carrying value, then we should write off the inventory amount to that selling price, because our inventory should always be recorded at the lower amount. Now another example is the discovery of fraud or error which happens after the year end. So in this case, the financial statements were prepared not on a true and fair basis because there is some elements of fraud or error in them. So it's right to do some correction after the year end to fix our financial statements. Now here's another example: amounts received or paid in respect of legal claims that existed before the year end. So for example, during the year I face a legal case and I am at a risk of having to pay $5,000 to whoever is suing me. So I would have recognized a provision or a contingent liability. Now the thing is, if after the year end the case settles and I do have to pay that $5,000, then I'm going to have to go back and adjust my financial statements to reflect that the case has been settled, because the case relates to the year in which the financial statements were prepared and not the subsequent year. Okay, so in here I've listed down the examples of events which do not require adjustment to the financial statements, but nevertheless they will still need to be disclosed to the notes of the accounts. So one of the examples here is when a value of investment falls between the reporting date and the date the financial statements are to be issued. So basically this is an event that has happened after the year end regarding our value of investment. Now the reason why all of these examples do not require adjustment is because they do not provide further evidence of a condition that had already existed during the year end. So in this case, the change in the value of our investment has occurred after the year end and therefore would be an adjustment to our next year's financial statement. Alright, I've listed down a few more examples. One of them is the acquisition or disposal of a subsidiary after the year end, announcement of a plan to discontinue operations or announcements regarding restructuring, legal claims beginning after the year end, which is the opposite of in the previous slide, which was about legal claims that have occurred before the year end and we have made payments or receipts regarding to them after the year end. In that case, that would be adjusting, but this one is not. And lastly, major purchases and disposals of assets. So basically, anything that is new that is going to happen and that does not have any continuation or have any connection with something that exists during the year end, then you will not need any adjustment. But I repeat, you will still need to disclose them to the note. So let's take a look at these following questions. Alright, so the first question says, which of the following material events after the reporting period and before the financial statements are approved by the directors should be adjusted for in those financial statements? So now we're looking for adjusting events. The first one says evaluation of property providing evidence of impairment in value at the reporting period. So this is an example of when there is a permanent fall in your value of your assets. So in this case, this is an adjusting event. Second, sale of inventory held at the end of the reporting period for less than its cost. And we discussed this earlier. We need to adjust our inventory figures to reflect a much lower amount because it was sold at less than cost. So this is also an adjusting event. Discovery of fraud or error affecting the financial statements. This is also an adjusting event because this gives evidence that our financial statements contain some errors or even were done on fraud or even include some fraud elements, and therefore they will need some adjustments. And lastly, the insolvency of a customer with a debt owing at the end of the reporting period, which is still outstanding. So the insolvency of a customer is another way of saying that the customer has gone bankrupt, and therefore they should be removed from our year-end trade receivables figure. And so this is also a adjusting event, and therefore our answer will be all of them. Okay, here's the next question. In finalizing the financial statements of a company for the year ended 30 June 2004, which of the following material matters should be adjusted for? So again, we're going to be looking for adjusting events. 1. A customer who owed $180,000 at the end of the reporting period went bankrupt. Automatically, if there is a bankrupt customer, this should be an adjusting event. 2. The sale in August 2004 for $400,000 of some inventory items, valued in the statement of financial position at $500,000. So in here, currently in our financial statement, we have listed our inventory at $500,000. However, we sold them at a price that is lower than $500,000, and therefore this is an adjusting event. 3. A factory of the value of $3 million was seriously damaged by a fire in July 2004. Now in here, a fire is something that is not providing further evidence to a condition that had existed during the year end. And therefore, something that is so sudden like a fire or a natural disaster, those are usually non-adjusting events and should just be disclosed. So in this case, number 3, we do not need to adjust for it in our financial statement. Number 4, the company issued 1 million ordinary shares. An issue of new shares, especially if it has taken after the financial year end, should be recorded in the new financial statements, as these do not provide further evidence of conditions during the year end. So therefore, the answer is 1 and 2, and that would be B. In this question, we are given a choice on to whether to adjust, disclose, or do nothing. So let's take a look at the first event. On 14 February 2002, the directors took the strategic decision to sell their investment, despite the fact that this investment generated material revenues. The key word here is that they have decided to sell their investment after the year end. And therefore, something that is material like this should be taken into the new financial year. And therefore 1 should only be a disclosed. 2, on 15 March, a fire had occurred. Now similar to the previous question, fires and natural disasters are counted for non-adjusting events. So again, you can immediately write this off as disclosed. 3, a customer went into liquidation. Okay, so again, automatically you should know by now that when a customer has gone bankrupt, this is an adjusting event. We conclude that our answer is C. We have come to the end of this chapter. Thank you for watching.